What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update video is, yes, as usual, we're going to be talking about the Ortex short interest and utilization data, and not just on AMC tonight, on a wide variety of stocks. We're going to be talking about the ETF IWM, GME, which had the craziest kind of pattern of securities lending that I have really seen today. And as usual, we are going to be doing this on AMC as well. Now, we also have to talk about what Fidelity is doing right now. They are actively campaigning against one of the APE's main goals right now, and that is securities lending and short sale transparency rules. This is not a very good thing to see, especially out of a brokerage that we all kind of trust right now as being one of the quote-unquote safe brokerages. Now, what are some of the reasons why they would want to do this? Well, we're going to cover that a little bit later in this update. Now, we did see another very flat day on AMC. We were down 7 cents, 0.31%. There is a very specific reason as to why we are seeing this type of price action, and we aren't really seeing these really volatile price swings anymore to the upside or the downside. And kind of the moral of the story here is the shorts and the market makers have a very big problem going into the end of this week and into the end of next week as well. So before we get into all of that information, if you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So Amy closed the day at $22.72. Again, better than having a very significant red day. I was hoping to see a close above 23, but we always have tomorrow and Friday to kind of screw over the market makers. So let's get into this Fidelity situation very quickly. So we've talked about this new SEC proposed rule that has come out in the past. It's essentially going to show us the size of the loans going out, and the most important part of this new SEC proposed rule change in terms of securities lending is we're going to get to see the type of collateral supplied and the essential margin requirements and the margin percentages that these institutions are agreeing to when these securities lending transactions take place, which is a very useful tool in kind of figuring out where we are going to see margin calls take place in the future in terms of price action. But here is one of Fidelity's comments, and you guys were sending this to me all day, and I just got a chance to look at it. So we can see that there's kind of some fluff, but what Fidelity is mainly talking about in this comment section right here is Fidelity supports enhancements to securities loan transparency that are clearly defined and provide investors in the marketplace meaningful information on securities lending transactions. Sounds like something we all want, right? But this is what they say next. Our comments on the proposal focus on the following areas. The SEC should exclude short positions from the proposed rule. How are you going to exclude short positions when you're making a rule that's going to provide more transparency in the securities lending market? And anytime a security is lent, most likely it's being used to short. That doesn't make any sense. The reporting time frame for the transactions should be no earlier than the end of the day. So they're trying to avoid the intraday reporting here, which if they're messing around intraday, remember, surrounding NSC 002, the central automatic margin call rule, where they were going to do those intraday checks on these liquidity requirements, rather than only around the times of monthly options expiration dates, they are messing around intraday. So Fidelity kind of obviously knows this and is trying to actively campaign against this. The SEC should clarify the scope of the proposed rule, particularly with regard to potential extraterritorial application, the definitions of what is considered a securities loan and what is available to lend, and the time a loan be considered affected for purpose of reporting. I don't really have any comments on that section right there. It's kind of just legal jargon that they really want to correct. Now, here's where we get into some other things right here. The SEC should provide market participants additional time to respond to their proposal and should undertake an outreach campaign to further understand the impact of the proposal on the marketplace. Now, this second part right here before I make any comments. The SEC should provide a minimum 2-year implementation period for any final rulemaking and issue any necessary guidance to implement the proposal a full year prior to the implementation date. What they're essentially trying to do here is, yeah, you can do your thing, SEC, here, but we're kind of requesting that you take a deeper look into this and basically say that this rule won't come into effect for at least 2 years. Why? Why are we not able to see the scope and what is going on in the securities lending market? Selling shares short right now is already manipulating the price. It is taking shares that somebody owns, lending them to somebody else, and flooding the market with extra supply that should not be there. The fact that Fidelity is doing this, and we're going to see if a couple of other brokerages pop up with statements like this as well, this isn't all that great. What is the issue with having more transparency in the securities lending market? Now, there may be an explanation for this right here. Now, this is not really to say, oh no, Fidelity's a bad broker, you need to move your money from there because they're going to hurt you when we start to run up. That's not necessarily what I'm saying. Fidelity is most likely going to see that it's possible that they are going to lose some clients based off of this rule. They may go somewhere else, like a Goldman, that can further skirt some of these rules that the SEC is implementing. And they are looking towards the longer term impacts on their own business because of rules like this. So that is one explanation. But again, this comment section right here doesn't look all that great for Fidelity. Now, coming over to AMC's Ortex right here, we saw some pretty interesting things happen today. So AMC in particular, well, we only have 76.33% estimated or utilization, 76.33% utilization, 19.32% estimated short interest with 894,000 return shares and 846,000 borrowed shares with a net return of shares of 48,000. Still low cost to borrow. We've gone over why the cost to borrow is so low in one of my previous videos. So if you want to figure out why that is, just go check out one of my previous videos. It has to do with institutions buying a whole lot of shares. But here's an interesting thing. When you go over and take a look at GME right now, and you see what they did in the securities lending market for GME today, they borrowed 1.14 million shares. Now that may not seem like a whole lot. We've seen AMC's securities lending market go all the way up to about 14 million shares borrowed in a day. But when we come over to GME over here and take a look what the actual volume was today for this stock, it is absolutely insane what we are seeing. The volume, 1.57 million shares. They took out almost as many shares that were traded today on GME. So what I see happening here has to do with what we've been talking about in terms of Max Pain and the honestly terror that these market makers and shorts must be feeling about these option chains coming up. When we go to the AMC option chain over here and take a look at just this week, this isn't the crazy monthly options expiration period coming up next week. There is a decent gamma ramp leading all the way up to 30. Now, $23 is kind of an important price right here, just because there's about 8,800 call contracts. But when you switch over to the puts, there's about 12,600 puts. So getting past 23 with some momentum is going to kind of shift the way that these institutions are going to be hedging. But in my mind right now, there's no reason for these institutions to be hedging. We've gone over this in the past, but it has to do with how these market makers are going to maintain that directionally neutral or delta neutral status. Now, what they typically would do is they would have to go on the open market and buy the appropriate amount of shares. So let's just go with this $23 strike on the call side. For example, let's just say there's 8,800 contracts right here. That would be about 880,000 shares, but the delta is only 0.44. So you would need to buy 44% of those about 880,000 shares, but they're not doing that. We finished below max pain on a couple of weeks. So when we see the call deltas start to decrease below that max pain price and the put deltas start to increase, they can maintain that delta neutral or directionally neutral status by not even going out in the open market and hedging, but by just doing their normal actions as a market maker. Because when these institutions basically sign up to be one of these market makers, if a retail investor or an institution comes to them and says, hey, I want to buy a put or a call, they have to sell it to them. Now, why is this $23 mark so important to what we're seeing on the chart for AMC right now? Well, we are really getting trapped in this range, and here's one of the reasons why. When we take a look at the chart for AMC, we see what happened the last time we shot down to 2080 at open. Well, we shot right back up above 23. But with what we're seeing right now, when we come over to the option chain on Untitled Chapter, there's even more contracts on the out of the money side for this next week expiration. And a lot of these contracts are piling in closer to the money. They're not going to be able to sell enough puts in order to counteract the call delta exposure that they are going to have. Now, what does this mean? If they get to the point where the window kind of closes, so there's kind of a window right now where they can keep the price and kind of trick their system into saying that, yep, we're delta neutral right now. There's no actual hedging that we need to go out and do. But once that window closes, and it is closing right now every single day with the amount of calls that are getting added to the option chain by retail and institutional investors buying, well, we are going to see them start to go out in the open market and hedge. What that means is that they are going to be buying. They're going to be buying shares and providing that buying volume that we've been all waiting for. So the market makers are very stuck right now in what they want to do with this options chain. The shorts are stuck because they know if they push it down, we're trading below fundamental value. So the fact that the shorts are even trying to chase it down at this point just shows how much and how desperate they are at trying to get the share price down. And in addition to this, there's also something new that I want to show you guys as well on IWM, the Russell 2000, which AMC makes up the largest percentage of. When we come over to the shorts over here, we are seeing that IWM now has about 34.9% estimated short interest. Now, what this is kind of telling us is that they are trying every single method in the books to try to kind of indirectly get short exposure on AMC without jacking up the utilization, the cost to borrow, with taking all of these shares out on loan. Because as we can see here, the cost to borrow on IWM, very, very low, utilization very low. But again, the last time that we saw IWM get to these high of a levels with this estimated short interest, we saw it significantly drop. There was a little bit of a baby squeeze on IWM, and we saw a lot of things start to run back up. So everything is kind of fitting together right now. But again, with what we're seeing on the option chain here, I want to make this very clear for everybody. Just because we are seeing a really, really high amount of potential for a big run, and if we start moving in the right direction, we could see a nice run up to the upside, doesn't mean it's going to happen. We need that one solid day, as we've been talking about a lot, of buying pressure to come in and kind of light that fuse to start that catalyst moving back up to the upside. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next one.